Hello and welcome to another episode of the SwingTrader Weekly Status Update. It's Justin Nielsen here, your host, and we're coming to you live on YouTube as we do every Tuesday on another January 14th, 2025 Tuesday. We've got a lot of the initial kind of, here we are starting the year, what's happening type things. Now we've got a year kind of coming into a little bit more focus, and so to help me talk about where we're at, really an inflection point, is Mike Webster, who joins me every week. How you doing, Mike?
Oh, good. Could you let me know what the CPI numbers are going to be and the reaction, please? I'll just take the reaction. That's fine.
Yeah, it was certainly one of those things. I came up with the headline, what does CPI have in store for us, basically? Can the market hold with CPI on tap? And so, yeah, I said, hey, I just write the headlines. Now it's up to Mike to answer it. But, in our last episode, we talked a little bit about how this has been a more reactive market. And, I think that kind of held true as we had a very reactive market again, our fear was that after the National Day of Mourning for Jimmy Carter on last Thursday, we had a jobs report coming right after that. And so you can see that Friday, it was a stronger than expected jobs report, and that led to some more destruction. We got a start of this week where we came down a little bit more, and then we had a nice reversal. Look, earlier today, Mike, it was looking like we were ready to go and maybe take out that 50-day moving average line. Not quite how we closed. So is this normal?
Yes, it's normally in the time where everyone is obsessed with the Fed. Until that settles down and we get a better sense of what they're going to do. Like at this moment in time, everyone's thinking only one cut this year. Some people are even talking about, raising, which I really don't think Powell would do, just because that would make it too much like the 1970s. And my opinion is he just, more than anything, he doesn't want to be Arthur Burns, who is, before Volcker back in the 70s, who kind of is thought of as really messing things up on the Fed side. So the Fed folks really care about their legacy, and they, we all do. Everyone thinks about their legacy, and more so for someone who's in charge of the Fed. So I don't see them raising, but that's the talk right now. And so until that calms down to where there's more of a consensus that's coming from the Fed, like, hey, we're not going to do anything all year, or we're only going to do one, some sort of more of a consensus type feel, then we don't have to be, at the edge of our seat for every economic number. But until then, look, we saw the jolts, what the jolts and the ISM did last week. You pointed out the employment numbers yesterday. We had some PPI numbers this morning that were on the good side. But the CPI, that and the PCE are on the bigger side of things. And, the CPI is tomorrow morning. So I think that's what the fade was going into the close. Let's just pull up the intraday chart. And,
this is the 30-minute chart right here.
So. Okay, that works. And you can see how, the tail end of the day, we just kind of rolled back because you weren't having enough oomph up there the way you should have after an upside reversal. So let's go back to the daily for a second and talk about the upside reversal. So when you're in a shakeout area like we are right now, and by that I mean you're underneath an area of support, but you haven't fallen dramatically. So this is a place where it can go either way. We can break down to closer towards the black line, which is your 200-day, or we could just rebound through your 50. So you're in this no man's chop zone. And with that, when you have an upside reversal, lots of times those are the absolute bottom, and you should rip up from there. You shouldn't just meander. There's times when you want to meander, and that would be the right side of a cup. Like that would be a classic, just inch up. But when you have an upside reversal, same thing with a double bottom, your second bottom, you should shoot up. So this was a bad day, even though we were flat to down just slightly, this is not the type of action you'd like to see. What you would like to see is more like what happened with RSP today, because that was a follow on from yesterday's upside reversal. So yesterday's upside reversal was a lot more powerful than SPY and the Qs and the NASDAQ. And let's just toggle back to SPY just for 1 second so people can have that fresh in their mind. So this is the market cap weighted. And you can see the upside reversal, meaning you shook out below a recent low, and then you closed near the highs of the day. That's a loosely defined upside reversal. Your expectation following that is to move higher. We went a little baby step higher today. Not what you'd like to see. That's more of a failure of the upside reversal, the expectation. Now let's go to RSP. And look at the same thing. And that was more normal and natural. So you came down, you undercut that area of support that was forming, came right down to your 200-day, and then had that really beautiful one yesterday. That upside reversal was really nice. And then you had a follow-on move. So this is kind of telling you that and you can see with the RS line too, which is that green line at the bottom that's relative to the S&P. So you can see that the average stock is now starting to act better than the averages, which you can't always get everything you want, right? Like before people were complaining about breadth, but
Right.
the mega caps were going up, and now the mega caps are kind of I don't want to say they're in trouble, but they're like kind of on the ropes a little bit, or they're in some kind of key places like FNGS. It's still hanging above its 50, so it's not broken, but it's tailing off there. But the RSP, your average stock, is doing much better, and that's what both of us were finding through our screens, right?
Mm-hmm. Right. And just since we're on the topic, I'm gonna go real quick over to our pie chart, because as we were building this, I thought it was really interesting that our pie chart this week is very spread out. I mean, there is, of all of our positions, there is not a single overlap in sector. So we've got a little bit of leisure, we got a little bit of utility, crypto, building, metals, software, energy, transportation, medical, and of course our biggest position is cash. At 26%, which is, look, we were at a much higher cash position last week, but because of that upside reversal, we have been adding some exposure. So yeah, this is where we're at. And look, if RSP doesn't work, this isn't exactly what you want to do, right? I mean, you can get lucky if you're in the right stocks in those groups, but if RSP isn't working, the more spread out you are, sometimes the worse it can be for you. Not always. Yeah. Again, if you're in the mega cap or you're in the areas that are working, you can still be spread out to a degree. But your thoughts on this kind of pie chart this week?
Well, we try to, because this is SwingTrader, it's not leaderboard. Leaderboard is, much slower and more orthodox, and just like putting something on and letting it bake, which is, I trade that way as well. Like part of my account, I do it that way. And then there's part that I do with more active swing trading. You kind of have to go where the action is. And right now it's spread out. Before, for a while there, it was the FANG stocks, that's where all the action was, and everything else wasn't working. Yeah, with some exceptions. So we're just having to switch gears, but really we're in a chop area. And let's go back to the market for a second. You can pull up the NASDAQ, and with this, when you're underneath the 21-day, when your close is underneath the 21-day, which is your green line, that's a time to be more defensive. When your high is underneath the 21-day, you want to be even more defensive. When your high has been under your 21-day for several days in a row, you get even more defensive. So there's you can make a very fair argument to be in cash right now, unless from a swing trading standpoint, unless you're, like orthodox trading, you're holding core positions, you have gains in and all of that. But from an active trading standpoint, and let's go over to SPY, because that's actually worse, because your 21-day is crossed through your 50 days. So that's a green line going through your your red line, and your red line is your 50-day. And that's a big deal for what you and I came up with Charles Harris with our market school rules. And when that green line goes back through your red line, if you'd been in a power trend, that ends it. So last week ended the power trend on SPY. It's still hanging on the Nasdaq side, but this is a time you could really just go to cash and wait until you at least get a close back above your 21-day, the green one. There's nothing wrong with doing that. I mean, I think you could really make probably a stronger argument for doing that than doing what we're doing right now. But we're also, we've got a product. We're trying to give people ideas who don't necessarily want to be in cash. I'm not in cash. I'm trading, a lot of the same things that we end up putting on. I mirror in my own account, and sometimes in different sizes. But we want to give people that opportunity to trade if they want to trade, and where to go. So we're spreading out, because let's go back to the RSP again. Your average stock having an upside reversal like that, and then having that follow on, that's telling you that the market, this looks like the bottom of a base, really the bottom of a cup, and you can visualize. Right. And you and I were talking about this pre-show, that you can visualize this having hit bottom yesterday and then just rounding out. But it would be symmetrical, exactly how you're drawing it. That would take time to go up the right side. That would be normal and natural. Wouldn't be normal and natural for the RSP to jump up to 188.16 in 2 days. Like, that's not going to happen. Like, I'm saying that, hoping that it happens, but it's not going to happen. It's like it's virtually impossible, because it's 500 individual names equally weighted. Yeah. But rounding out the right side, that would be normal and natural. And with that, we wanted to have exposure now rather than waiting until you get up there, because then you lose a lot of performance. But with that said, everyone should who's swing trading and kind of following our stuff, you don't have to be buying these. You don't have to be buying them with the size that we're buying them, with the full positions is what we're starting off with these days, and which is a 10% position. If you want to, follow along, you can do 2.5% position. There's nothing wrong with that.
You know what? I want to address that, because Gary, I'm looking at the YouTube comments, and there's some good ones here. Gary brings up, hey, why are you taking full positions during a weak market when you're under the 50-day and 21-day? And there was a response where, someone was saying, look, I've been taking half positions. The full positions mean half positions for me in this market. And Paul was saying that, I've bought almost all of the swing trader ideas in the last few weeks, but I've handled it differently, and I've gotten out of all of them positive. And by the way, that's great. We want to hear that, kind of action. Yep. You don't have to follow us exactly. At the end of the day, this is an idea generating product, not something, we do a model portfolio so that we can kind of talk a little bit about how these pieces fit together. But at the end of the day, we want people to kind of use it in their own way. And I think that's great. I love hearing that.
That's music to my ears.
Right.
And because we try to tell people that, every week. And that's why we wanted to do this video once a week, to kind of guide people to what we're thinking. And we're going to talk on Thursday. We're going to have another one of these, a little bit different than this. Today's a typical Tuesday, but we're going to be talking about the new strategy that we're doing for 2025. We did a post analysis of last year, and we needed to make some changes. Frankly, when you don't get the results that you want, you have to look at it and see why and address those. And a lot of it was, I was trying to do my shotgun approach watered down, meaning personally, when I go out and, buy a bunch of things, I buy a bunch of small positions, like 2.5% positions, or even 1.25% positions. The ones that are working, I'll add on to those and make them, bigger positions. And, I'll reverse pyramid and quickly make those a 10, even 15% positions. And the ones that aren't working, even if I'm down just a little bit on them, out they go. And we tried to do a combination of that with this. And we were getting, pushback of, how many alerts everyone was getting and how it was hard for people to follow along. And I thought long and hard about that. And I just really wanted a product that people could follow closer.
Right.
And it was less frustrating, and hopefully yields better performance. So we're doing
Well,
it
and for example, Mike, just real quick, how long does
Yeah.
it take you when you're doing that shotgun approach? How long does it take you to put in a trade?
Oh, not long at all. I
A
mean,
second?
yeah. I mean,
Yeah.
yeah.
Right.
Yeah.
So for us, again, because we're writing something up, because our goal is to be instructive. Because we're writing it up, and everything like that. We are also reliant on alerts. We have an alert system that pushes out notifications. All of that takes a little extra time, and that is one of the reasons why following exactly what Mike does is probably not the right thing for this product. If it was something where, okay, we're just gonna put a camera on Mike and look at his computer every day, okay, that's one thing. But other than that, it's kind of difficult to add the explanations. And if we're not adding the explanations, then what's the point? We don't want to just be following what a single person does, because as we said at the beginning, you have to really kind of cater this to your own style. Not everyone is sitting at the computer for as long as Mike is. Some people are, some people aren't.
I hope not.
Right, exactly. So some people have lives and things. So that's one of the things to consider. So getting back to the thing that you mentioned,
I will just say, because we're going to go in depth on it on Thursday, so we don't want to take all that time up. But we're trying to simplify this and do it more of a strategy of the style that the two of us were doing back in 2020.
Right.
Where for now we're putting everything on the same size positions to keep it easier for people to follow on, rather than starting off some with a quarter, some with three halves and everything in between. And we're going to start off at the same size. As they go up a little bit, we're going to lock some in, and that helps with the math as far as for your batting average and everything of getting some in even early on, locking in some while it's green, and slowly raising your stop up almost like a trailing stop each day. A combination of things is hopefully going to make it easier for people to follow along. And hopefully fewer alerts, but still very active. And I just think, I still want people to do their own thing. Like those comments you were saying from the YouTube folks, I love that. Like, just take the idea and just go, if you look at it and go, oh no, I already have two other stocks in that same group, I don't want that one. Don't trade it. Or when we remove it, you don't have to sell it. Like we put Palantir on today, and we took it off when the market was fading and it was a high ATR stock, and we didn't want to give it too much room. And we took that loss right away, and I gave it a little bit more room in my own account. And then, towards the end of the day, I exited it. And so there's nothing wrong with that. You don't have to remove it, sell it when we remove things.
And for example, I continue to hold Palantir, but I had a smaller position. I didn't go with a full size position. I went with a smaller position, and that kind of allowed me to hold on to it. Again, I'm down slightly on it, but it's a smaller position, and my plan is to again layer in. Someone was saying, hey, they prefer to layer in, and that's great. If that's what works for you. So again, we're going to talk a little bit more about some of these strategy changes in the same way that we did for those of you that joined us in May of last year. We're going to talk about some of these on Thursday. It's going to be at 1:15 p.m. Pacific, 4:15 p.m. Eastern. Both Mike and I will be there, and we'll spend about 45 minutes on this. But let's get back to some charts, because that's what we love to do. We kind of tackled all the main points on RSP, but one of the things I thought was going to be pretty instructive is, and it's funny. We have Russ Britt, who is one of the assistant market editors, and he's in charge of choosing kind of the IBD 50 stocks to write about. Right? It's computer generated list, but Russ chooses, okay, what are we going to talk about today, or write about, and he assigns those. And he's saying, folks, is it just me, or seems like there's a lot of setups? For as ugly as the indexes look, I wouldn't have a few weeks ago, I didn't have very many setups that I could talk about or assign. And now there's a lot, despite the fact that the indexes are looking pretty poor. And we're just going to go through some stocks real quick. And this is kind of a list of 22 stocks. We're not going in depth on all of these, but we want to kind of share some of the things that are sticking out to us. But first, let's go ahead and discuss Palantir.
Sure.
Palantir did close up for the day, but if you were getting it up at the top, that was still probably too much of a loss.
Chart right now.
Oh,
but I have that chart memorized. I could draw it if you need.
Perfect. So here's Palantir. Nice kind of reversal, a little stop there yesterday. And again, we were back above the 50-day moving average line. And that's what we were kind of using as a potential area to be careful of, or yesterday's high. But it just got to be a little bit too large of a loss for a full position. So
yeah, exactly. So if we were doing a quarter position, we could have left it on, a little bit longer. But that's that teeter-totter, that balance between if we're going to simplify things and make everything the same size. And right now we're keeping things at full, which is a 10% position. It was too big of a risk going into tomorrow's CPI, because let's say tomorrow's CPI is higher than people expect, or even a lot lower than people expect. Like, we just want it within expectations, really. We don't want any surprise, and we get a gap down. And even on the market, let's say we get a gap down and then it reverses higher later in the day. Well, we're going to get shaken out of this at the lows. And so it was just too much risk with this one, but we also didn't want to let it go earlier. We didn't want to let it go by not putting it on earlier in the day when it was moving up and it looked like this is a perfect test of your 10-week line. Let's go to the weekly. I think it's a little easier to see there, where when a stock has a big move like this, they don't always stop right at your 10-week. Sometimes they stop at your 10-week, sometimes at your 50-day. Just because one's got 10 data points and the other one has 50, sometimes they're at different levels. And so this one had already crossed below it. And lots of times, when it was still just barely underneath the 50-day, that's where you get support. And if you didn't get it then, yesterday or today, and if it gaps up tomorrow, well, if you have a tight stop, you're not going to be able to buy it, so it's going to be too far out of there. So that's why we were taking that shot, but we were also managing our risk by just saying, you know what, it's not working out. We've got this risk event tomorrow. We're going to go ahead and back away from it. I still think it looks fine. Like, what's the weekly closing range right now?
Let's see.
Yeah,
looks like 52%. So
yeah,
halfway.
So, and it's in that position where Bill O'Neill, the founder of IBD, would always talk about, is like when you're coming down and you have one bad, typically you would talk about it on 3 weeks in a row, where you've got a really bad break and then, a little bit less. And then your next week is like almost unchanged, is this supporting type of feel, like it's coming in and it's getting supported because the volatility is contracting or getting smaller. And so that was a big concept of his,
and a lot of times you would see volume still rising, and he would call it heavy volume without further price progress on the downside. The opposite of our heavy volume without further price progress on the upside, which is stalling. But it was kind of almost reverse stalling, right? The selling
exactly.
was just, kind of dissipating.
Yeah.
Or it was getting gobbled up. The way he kind of told the story sometimes was, okay, for every seller that's out there, you've got the buyers just waiting in the wings saying, yes, I'll take your shares. Thank you very much.
Yeah. And he would also say that sometimes you would have, like, for every 100 sellers, you might have 10 buyers. So, but the buyers have a lot more money, it's like you've got a bunch of small accounts are going out, and then the people who are really supporting it are the ones that have hundreds of thousands or millions of shares to accumulate, the mutual funds, the hedge funds of the world. So that was the concept there. But, this is something that is in a short-term downtrend, and it didn't respect the 10-week. And at this point, it was like, it wasn't respecting the 50-day. It was backing away from that. And so you just have to, exit that trade. If you're still in it, the one thing you have is the gap risk on the CPI tomorrow. But I would say if that wasn't there, just using yesterday's low would really be your better exit, as
Mhm.
long as you're comfortable with whatever size you have. So that's
And
something to keep
I
in
did
mind.
sort this. I did sort this by ATR with the highest ATR first. And again, this is just a list of some ideas. And again, we'll go through this pretty quickly because there's one more thing that we want to go over, and that is the 2011 precedent. So we want to make sure we leave
Oh, we'll
time for
be good.
that.
Well, let's
That's
just show them the list of stocks then, maybe.
well,
Or do you?
we'll go through because I think
Okay.
it's important to kind of see that relative strength line. One of the
Okay.
things that is really important with a lot of these, and Apple Oven, kind of a similar thing. One of these high flyers that higher ATR stock, relative strength isn't quite there yet. A Lab, also a high ATR stock. So Broadcom, Bros. Now Bros, this looks very different. Relative strength, really, showing some power here.
Yeah, I do have a position in
I do
this.
have a position in this one as well.
We almost put it back on. All these stocks that we're showing, this was our list of things that we were looking to add today. So we had 22 names that we could have put on. Like obviously there wasn't enough room in the account at full size to put all of them on, but just showing you like these. There's so much, like what you were saying. Russ said, "Oh, look, all these stocks are looking good. The RSP is looking good, obviously." Or firming up that there's a lot of merchandise out there. And so I think that Bros, still looks good. We could have put that on there, but we were looking and saying, we're already probably too deep going
Yeah.
into a CPI. We're at
Right.
like 73% or so. Really, we should probably be more like 40%.
Mhm.
So with that in mind, we just didn't put the Bros on.
And it's funny, we were talking about, okay, well, if we had done 3/4 positions, lighten up a little bit. Mike was like, yeah, I mean, that would have gotten us, a little bit lower today, but I probably would have added another stock. So,
I would have, yeah.
Here's Eat, again, another one where relative strength, very strong day today. Relative strength, blue dot on energy, NRG. A lot of the utilities were looking interesting. Twilio kind of came in, but that's been holding up okay. This one came in as well, but Spotify and relative strength still holding above moving average lines. Another blue dot for health equity. I think this was stock of the day today or yesterday.
Mhm.
DTM. This was we really wanted some exposure to this space. Oil and gas. This was one that was on the short list of almost going on. Blue dot
Yeah.
looking strong.
That group in general looks so good, and there's so many in that space that we were both
Mhm.
noticing that, and we were trying to find an ETF that really gave us what we wanted in that space, but that's a can of worms.
Yeah. So Howmet, this one, very strong day. And I mean, look at how some of these, not only is their relative strength line strong, but Howmet closing at the peak of its range today. Very different look from the indexes. CF Industries, I mean, it had a big day yesterday, held those gains today, and you can see a screaming relative strength line. Baker Hughes, this is something that Ed and I talked about on the Stock Market Today video yesterday, right there, finishing out a cup. Nice close, holding the gains, the strong gains from yesterday. Relative strength, blue dot. This one is kind of getting GoDaddy, nice support, a good follow-up on the relative strength. I mean, not on the relative strength, on the reversal, just below the 50-day moving average line. ET, another one of those that was on our short list.
Go back to the GoDaddy for 1 second.
Sure.
That's what we would have liked to have seen with the Palantir.
Yeah.
A close like that and staying above the 50-day. And we didn't put this one on because we put Wix on, and they're so similar that we didn't want to double up in that area.
Mm-hmm. But I mean, Wix was not doing too bad, and I I thought I owned it, and I did yesterday, but sold it to put it on SwingTrader, and
Yeah,
then
me too. I forgot to buy that one
didn't
back.
get a chance to buy it back. So so GoDaddy, we were looking at that. ET, another one like DTM in that space, strong relative strength.
That one likes
Mike and
to
I, of
phone
course,
home
aren't
often.
oil and gas experts. We can recognize that on the chart something's going on there. We don't know what, but something's happening. So feel
Yeah.
free to add that into the comments if you're an oil and gas expert. We'd love to hear from you. ETR. Oh, go ahead. Okay, yeah. So ETR, this was a utility as well. Williams Company, also in the oil and gas. Nice breakout there. Strong relative strength. LNG, I mean, this just screamed out of there. It got away so quickly. 6% move. This is a lower ATR stock. I'm going to just pull this up real quick if I can. Oh,
That's hard to look at, man,
yeah.
because I wish we had put that on really 2 days ago.
Yeah, so LNG, the 21-day ATR percentage is actually below 2. So this is a fairly low ATR stock that just kind of screamed out of there.
Yeah.
And then also MPLX, this is one that it's a limited partnership. So some people were, saying, oh, I don't want that. I hate K1s for my tax purposes. What was the name of that ETF that I came up with? AMZA, I think.
Yeah, there
Yeah. So
were
this is an
yeah.
MLP ETF. So I believe, and someone check on this. I believe you get a 1099 on this instead of a K1. So some people prefer that in there. But anyway, yeah, the MLPX is a limited partnership, so you will get a K1 on that. But strong relative strength, strong blue dot. F5 also, strong relative strength. And I mean, these are all over the place, right? We had oil and gas, we had, utilities, we had some tech, we had, here's a computer software financial rounding out the space with SS and NC, another one where really strong relative strength. So pretty impressive.
Yeah. And frankly, there were more, but that was a shorter list, of ones that we were considering for SwingTrader. So the reason why Justin and I wanted to share that today was just as a positive sign for the market, because that's one of the things. If there are a lot of stocks that are setting up to be bought, that's good for the market. If we were doing the same thing and there was just nothing in position, then we'd be more bearish. So. But with all that said, it really just depends on the reaction to the CPI in the very short term, what ends up happening.
Mm-hmm. So, Mike, last week we shared some precedents for people to look at. This is some 2 ATR drop, where you had kind of what we had on December 18th, a bad drop when you were in a power trend. Your high was above the 21-day moving average line. You fell below it in at least 2 ATRs or more. And Mike went and highlighted the ones that were 3 ATRs because that's kind of where we were at on the 18th of December. And so, screenshot this, pause your video, go back to this. These are some that you can take a look at, but we're going to look at one in particular. We're going to go to this 2011, 222, 2011. We're going to take a look there. So let me go to... this is going to be on the NASDAQ. All of those were on the NASDAQ because as I was doing my my data spreadsheet stuff, that is on the NASDAQ. We have that going back to 1973. So I'm going to share this and take us back in time.
Sure. And for people who want more on this, this Sunday I was going to put a tweet out with this again, and for people to do the homework. But I figured, you know what, I'll just walk through how I do it. So I did a quick little video and put it on my Twitter feed or X feed. So it's Webster 1971. If you want to watch that, it's my pinned tweet. But this is one of the ones that I went through. And so you're in the same setup that we were going into the 18th of December. You're in a power trend, and then right off the top, you get this really bad break on that day, closing at the lows, going through your 21 day. So now we're going to go out a little bit in time to see how this played out. And so now, very similar to our recent market where you came down and then you came back up through your 21 days. So when you're doing the homework and going through and looking for other precedents, you want to see similar setups. So some of these, when you had your bad break, you just kept going down. And some of them, you just went down for another day and then shot back up into new highs. But there is this group of them that kind of did this similar to what our current market is doing, where you tried to go above your 21 day, couldn't hold it, and then you came down, you undercut your ultimate lows, and that's like exactly what happened with our current market. Then you have this little upside reversal. Um, then the next day you undercut that, which is, kind of weak action like what we saw today, but that one was worse. Then you go lower. So this is what I'm worried about. Like this could be
And we could easily see
tomorrow.
the CPI do this,
Easy.
right? Yeah.
Yeah. And that's why we removed the Palantir, because we were fearful that this might end up happening, knowing that we would get shaken out at the lows there, right? So we can go forward to the next date. So why we wanted to show this is those of you who are taking SwingTrader and you're following along, if you don't feel comfortable buying when our high is underneath the 21-day, which I am 100% on board with. I think a lot of people, if you just never want to buy anything when the high is under the 21-day from a swing trading standpoint, I think that's the better way to go, frankly. But if you are going to be trading, just you can reduce the size until you get into a position like this, where you at least get your close significantly above your 21-day, preferably the low above the 21-day before you start taking it seriously. Now, why don't you walk through the downsides of waiting that long?
Well, I mean, here's the thing is there's no free lunch. You got to pick your poison, right? Both are hard. It's the old choose your hard. The hard part about staying on the sidelines is that you're gonna miss out, right? You're gonna be underperforming as the market goes up without you. Now, when you're doing individual stocks, you can catch up pretty quick, but you are going to have that period of time where you're not, the market's going up without you. You're going to get the FOMO, and sometimes some of the stocks aren't going to be set up as nicely. By the time you start seeing the evidence that, oh, this is for real, a lot of things might be extended. So that's the risk there. Now, if you do get in, the risk is that you go lower, that it doesn't work. You turn around instead of going up to the 50-day moving average line. Let's say you are at this upside reversal and then you go lower. So you have to be careful not to be too heavy because you have to protect yourself from those things. So again, it's, both things have their issues. It's just a matter of you choosing which one would hurt you more or how do you mitigate that risk? Oh, I'm going to go with smaller sizes. Oh, I'm going to be a little bit quicker to exit if I need to. Mark Minervini was on the podcast at one point, and he was saying when volatility gets higher, you would think I would, loosen my stops, but I tighten them because I'm just saying, like, look, I'll take the small loss over and over again, waiting for that time where it's going to work. And, I just don't want to take the big loss. So yeah, you just got to choose your heart. And we're going to go a little bit further out to see how this.
I do want to point out one other point on there. Do you see that 1 day, like 2 weeks off of your top where your low got above your 21-day? Yeah, right there. So if you're using that.
Oh,
it's okay.
So here we go.
Can still point to it. If you're using that strategy of waiting for your low to get above your 21-day, you have to be aware that this is going to happen a lot, where you do get there and that ends up being the peak for that little part of the move. And psychologically, can you handle that or not? So probably for a lot of people, it's a little bit of a balance, a little bit of each. And it's kind of a soul searching of what do you feel comfortable with? In general, like I like pushing it when your low is above your 21-day and has been doing that, 3 to 5 days in a row, and you really have the wind at your back. That's what the whole power trend is about. Is it's proven itself. You're moving up there, kind of like where you are at this point now in the market. Once you got through the 2,800, you had enough distance between your 21-day that you're like, okay, it's time to go ahead and gun it again. But that's a lot of time in there. Like on here, it just looks like a little bar, but that's day after day. And you've got to have your watch list ready. And that's a lot of sitting on your hands. Some people are good at that. Some people aren't. I'm not so good at sitting on my hands. I like to be active. It gives me a feel and feedback for the market. So that should be your takeaway for today is, look at this one and just be intellectually honest and with yourself and just go, at each one of these points, what would you do? What would you be thinking? And in a perfect world, how would you have traded that?
Yeah. And look, this was after a really strong rally. If you remember, for those of you that were trading back in September 1st, 2010, a really great follow through day, Chipotle Mexican Grill breaking out from a perfect cup with handle that day. Netflix was breaking out. So it was a really strong rally. And look, 2011 was not easy for most of the year. For those of you that, again, just a little bit of a history lesson, for those of you that remember, for a lot of the year, it got really sloppy after this. We went into a whole global recession fears, Greece and Germany kind of fighting over austerity. And, there was a lot going on globally that put a lot of pressure on things. So not that that's going to happen this time around, but that was the backdrop for 2011. So I think we can wrap it up there. Yeah. Any final thoughts?
No, just be careful out there. Really be careful until we're, back above the 21 day, regardless of what we're doing with SwingTrader or what the guys are doing with Leaderboard. You don't have to do anything. You can wait this out because there is a lot of risk. We've got the, with inauguration, we're going to get, a lot of news from the new administration of what they're going to be doing, what they're not going to be doing. That's going to impact a lot of groups. And there's nothing wrong with dialing things back until we get that evidence out and you start seeing Powell come out and talking and getting a sense straight from him, because lots of times he'll send out his people and they each have different messages and the market sells off on one person. And sometimes
it feels like it's just testing the waters, right?
Yeah. They always say they don't do that. I think they do, even if it's on a subconscious level. One governor will say one thing, market sells off. Another one says the opposite, market goes up. And I think they get kind of a feel what the Fed funds futures is doing, what the bond market is doing, what the stock market is doing, and then decide what to do. And so this is a chop fest. So, be careful. It's a time to do a lot of homework and keep your watch list ready, because when the market does turn, and that's why Justin and I and Dominic have these watch lists ready. So at any point you can get this real turn in the market and you don't want to start screening then. I'm screening all day long, every day, including weekends. I should probably dial it back.
Perfect. Well, hey, thanks a lot, Mike, for sharing your thoughts on the market. That's going to wrap it up for us this week. We really appreciate you all showing up. And again, don't forget, we've got that SwingTrader webinar that we're doing on Thursday, starting at 1:15 Pacific, 4:15 Eastern. We hope you join us for that. Mike and I are going to get a little bit more into some of the strategy changes that we're doing on SwingTrader after our post-analysis, and also just kind of introducing the product to folks. So we'll be spending a little bit more time on the product itself. But thanks a lot, and we'll see you next time. We'll see you next week. Take care, everybody. Bye.